projections on the 10-year Treasury for those of you guys who like to place bets with your friends where interest rates are going to be. CBRE's predicting that interest rates in the threes in a couple of years, and then maybe settle somewhere in the three long term, focusing on multifamily one tier. They're pointing to right now is the peak of the prevailing cap rates, which since we know from the last slide, that's bad, right? That means your property is worth less. This notch to this notch, that's a half a point correction or compression in 3 years, maybe a little bit more than a full point in 6 years. The Chatham Financial curve, you're seeing us at 3.68 come this time in 2025. All right, well, welcome, folks. This is the last quarter of the 2024, or call it the 2025 preview, depending on how you look at it. My hair is super long, which means I'm trying to save some money, not getting a haircut before the holidays. Just timestamp this webinar if you're catching this up on replay later on. But today, interest rates have come down maybe about 10, 15% off the peaks that were previously set was 5.5%. We had an election, we had a couple rate cuts, half a point and a quarter point, which puts us still very high. Just updated this chart, 40-year high, quickest time in history, which is the big thing. And this puts shockwaves through commercial real estate, because in commercial real estate, a lot of times what you have is bridge debt being used. And bridge debt is loosely defined as 3 to 5 year terms or less, meaning that if you have a big correction, which boy, did we have a big correction. How did it compare with the Great Recession of 2008? From there, we saw commercial real estate go down 29% from the peak. And this time, article from JLL, from this article right here, if you want to take a look at it, Fed saying 35% down from the prior peak. So normally, or at least what I'm taught, normal corrections are about 10 to 15%. Obviously, this was a doozy in comparison to this. And the reason being, inflation just skyrocketed because the government created a whole bunch of money to keep us afloat during that pandemic. Yep, you remember that pandemic. Some of us forget. The Dodgers won recently. And when did Freddie Freeman win the last MVP? And it's like, why did they only play like 45 games that year? Oh yeah, the pandemic, I forgot. But it seems like we quickly forget. But that's the quick recap on where we came from over the last 4 years. And over the last couple of years, complete bloodbath, if you ask me. We've been heavily impacted, more so the deals purchased at the peaks, which we all know now was 21 to 23. But it's difficult, and if that's the vintage and projects you're in, but unfortunately, it's kind of a new day, and it's two sides of it at this point. This is what we're seeing as a different viewpoint of pricing. In a way, you see that kind of run up in 2020 to 2022, and then the steep decline that happened after. So right now, some perspectives on the market. A lot of operators and institutional groups. You're seeing the big players jump in at this point. KKR spends $2.1 billion. You're seeing the big hedge funds out there grabbing commercial real estate. Not so much office. We'll get into that a little bit later. But this excitement around buying distress. And I think we've been getting a lot of questions from our investors. There are a lot of properties that were bought at the peak. And whether you run the assets good or not, the price has come down. And even if you use longer term debt, 4, 5, 6 years, or maybe you own the property since 2018, 2017. And if you're doing the math right in my head, if you had a 6-year term, your note is coming due and your property may be worth pretty much what you bought it for, just because the market came down so heavily. So you're having a lot of these situations just because of the loans being used, which is pretty consistent in the commercial real estate world. Now, what I wanted to make the distinction of is when properties are into the state, what you'll start to have happen is the operational funds are going to get dried up. And at that point, your asset still operating, still very well, may have good occupancy, but it starts to become a little smelly. Not quite rotten yet, but you start to have owners may not fix things, may not be up and up on the tenant profile being brought in. I think from our perspective, though, I don't really want to go into a distress asset or one of these so-called good deals per se, because I can just buy very clean assets that don't really have any smell or decay to it because the entire market has dropped so heavily. Like you're buying things at such an amazing price. In particular, you're picking up properties that are brand new build that you would buy a few years ago that were like 1980s property, something like 40 years newer. You're buying it for the same price today. So the way I look at it is, first of all, you don't need to go in with the bridge debt type of business plan. You can just do it a long buy and hold. And because you're buying it at such as a good price, or what we call it in the industry, buying it at a good basis, such as today, you're going to make money, assuming you implement your business plan and the market stays pretty neutral. At that point, why go after these more hairier assets? Now, I get it. If people want to do that, more power to them. And I think they can make a lot of money doing that. It's just, I'm looking at it as if you can make good returns, why take on the extra risks? If anything, right now is that kind of that time where the prices have come down to a point where things just lights up the spreadsheet in a way. But from a market perspective, and we'll get a little bit more into detail on this, you're having a lot of new supply hitting the market, which is making things a little bit more difficult for the lower end properties, the Class C assets, which is why you're seeing us target a little bit more nicer properties, more Class A. And then, like I said, that the major players are bringing competition back to the market. It's your newer investors, your retail investors that are ones that are saying, I need to wait to see who wins the election. And I need to get confirmation. I need to see 3 or 4 good years in a row, and I'll be in 2028. Trust me. We all know inherently know that's the wrong thing to do, but that's ultimately the natural tendency for retail investors and the complete opposite of institutional purchasers like KKR. A lot of this is dictated by interest rates, which impact the cap rates. And I've always been looking for a certain number of correlation percentage. It took me a long time, but I finally was able to track down somebody who stuck their neck out there. And whether it's right or wrong, I actually think it's correct. If you take it as a general rule that 70% correlation between the cap rates and the interest rates, with the remaining 30% driven by market sentiment and other factors, essentially meaning that commercial real estate is heavily impacted by what the interest rates. We had a question that somebody put in here. They're talking about residential real estate. So residential real estate is very different than commercial real estate. We've traditionally stayed away from residential real estate because of the risk factors, working with smaller operators, and how much it's really not correlated with the performance of the asset in terms of the operating budget, where at the end of the day, residential real estate is dictated off of the comparable sales. What we've seen as the interest rates turn up, you're seeing a lot of people stuck in their mortgages. People who have houses who locked in aren't going anywhere. So they're prisoners in their own houses. You can say that the buyers, the new people trying to get in, are taken out of the market at this point. But because of the low supply in residential real estate, you're seeing the prices stay stabilized. But the difference with commercial real estate and what's created this great opportunity for new investors to now come into the market, as you're seeing the big players do, is that because you have a quicker turnaround, you don't have 30-year mortgages in commercial real estate. Sure, they're amortized in 30 years, but you have these loans reset quicker, whereas typical ranges are from anywhere from a year to 12 years is the longest that we normally see or we have in our portfolio. We could get a 15-year mortgage, but it's typically you pay more for a rate, right? So there's always a trade-off between the term and your fee structures that you get assessed by the loan. There was a white paper in 2016 put together by TIAA Global Real Assets. Might be a little bit outdated. They said 70% correlation between cap rates and interest rates. It's not 100%, but it's more than 50%. But I think what we've seen over the last couple of years definitely impacted pricing, right? Again, interest rates skyrocketed from pretty much 0 to 5.5, 40-year high and commercial real estate prices came down, what, 20, 30% off the peaks. Some would even say more than that. So where does this put us now as individual operators here? What's my viewpoint? When we look at new deals and we're modeling the exit cap rates, it's a head scratcher because right now the cap rates are so high. Meaning, if you're new to this, what I would highly suggest is go to the numbers section of the syndication e-course and take 15, 20 minutes and read through the reversion cap rate discussion. But when your exit cap rate, or other known as the reversion cap rate, is incredibly important, and it's one of the biggest ways that operators fudge their numbers to make a deal pencil out or project out better than is. Generally accepted in the industry that when you underwrite, you want to try and be a little bit more conservative. That's something that we've always followed ourselves. And we want to model an exit cap rate that takes into account a weaker market. What we've seen is, like, over the last couple of years, cap rates are very high, meaning that the higher the cap rate in the prevailing market, that means the less money you get. And thus, as you can see, the prices are down. But we've seen in some markets possible compressing of 75 basis points off of their peak. So that means coming down, meaning the prices are getting stronger. Now, it depends on the market, it depends on the asset class, of course, but these are the signs that you're starting to see that bottom develop. Maybe it was 6 months ago. Maybe it was a year ago, right? If you're somebody who's saying, I'm just going to wait until I get confirmation, you're not going to hear about it in the news until a year or two later. The Wall Street Journal, you're always going to be at like 6 months, a year behind in that thing. Ultimately, it's the brokers that have their finger on the pulse where the cap rates are trading for at that moment. But what we do know is a confirmation of the top of the interest rate cycle. I think it's safe to say that at this point, that we saw the top of the interest rates, as we've seen a half a point and then another quarter point very recently. I'm not going to say with Trump now going to be the next president. I have an entire slide on that coming up in a little bit. Obviously, I think his stance, whether he gets his way or not, is that he brings these rates down quicker, right? But at this point, the best estimates, what we do know is the top has been confirmed. And the general consensus are things are going to start to come down slowly. And if you're seeing these prices are correlated by 70%, one would assume that these prices are going to get stronger from here on out. Here's Green Street. They've put into this image here that they're saying that in Q4 of 2023, they predicted that was the bottoming out, as they're starting to see that reversal over the next 6 months into June, which is in our rearview mirror. I don't really want to put things out prematurely, but if you're somebody who's, let me see another year or two from today, these are the signs that we saw 6 months ago to this date. And as we all know, it's 2010 to 2012. If you were around, I think all of us were living at that time. But did you have $100,000, $1 million in the game? Perhaps you were just investing in the stock market stuff, so you're insulated here. And that one's a head scratcher, right? That one's kind of like at all times highs. I have no idea why. I'm just going to focus on what I do. But if you're an investor who sees things as right now that is hot, that's overheated, and commercial real estate is down. Of course, we don't only do commercial real estate. We also are now in buying businesses and private equity, which have their own market cycle. Everything has its own market cycles. And the idea that I go off of is you try to diversify. I was heavily in commercial real estate, so a lot of my lessons are made in blood there. This is the run up that we saw from, like I said, 2010 to 2012. That was a great time to be involved in commercial real estate. What we're showing here is the Arbor small market multifamily price, which is more of, I think, the kind of apartments that will target the Class B type of assets, the non-institutional type of assets. The boring apartments, this kind of mimics that more closely. But this is the pricing index, and you're seeing that big push up after 2020 when inflation just rose. And if you're concerned about inflation, you buy assets. I don't care if it's real estate, but you buy assets because assets typically go up with inflation, right? The worst thing to do in an inflationary environment is to hold on to currency, because that's the thing that doesn't really go up in value, gets devalued in those times. Like I said, the interest rates went up mid 2022, and that became, there's your 70% correlation right there. And now, as things are going back up in terms of you're seeing a little bit tick up in prices, and because of that interest rates come down a little bit. I still say there is still a delay, and that's the uncertainty here. We know that interest rates are going to come down, but to see the true impacts of a 75% basis points of interest rates, I personally don't think you're going to see that for at least another 6 months. Might even be a couple of years for all we know. And that's that delay factor that's not really accounted for. But we know where the momentum is heading. This is a big cruise ship. The ship is not positioned and turned the right way, but the motors are moving in that direction. What you're seeing, if you draw a straight line here, you're right back at, if you went and took a nap in late 2020, that's where the prices are at today, in a way. This is from ITR Economics. Supposedly, these guys predicted the 2008 recession. There's a lot of other guys out there that have YouTube channels that predicted the last 8 out of the last 2 recessions, as we all jokingly say. They're always predicting the end of the world, and then they delete this video, that video, so their batting average is a little bit better. A lot of people subscribe to doom and gloom, but very little people, I think, are willing to stick a flag in the sand and actually put some money where their mouth is, as that's where I'm at. I don't know if it's a bottom. I think the way I look at it is the prices look good. I think if things pencil, then just take the dollar cost average approach. But as far as ITR Economics are saying, housing has hit this hard landing and is on the up. And if you're believing in the soft landing for some of these other sectors, is what you're hearing, this is what's coming out of it into the next year. What we do know, and this is in hindsight because this did happen, is your financial sector, which is those guys went through the hard landing portion and now they're coming back up. And housing and financial sector, because again, housing is 70% correlated with interest rates. That's what goes through the hard landing there. And this is the tough part, right? Like, this information that I'm telling you is not really useful for the next 5 years. If you're seeing how this is lining up, the next 5 years are perceptively good times. But what we need to keep in our mind, and where I try to just stay a student of the game here, is the next time interest rates get cranked up, things get shaky in the economy, it's the financial and the housing sector that are going to lead the charge into the hard landing first, and then the rest of the sectors follow. And the way I think about it in my head, it makes a lot of sense, right? If you can't borrow money, liquidity dries up, it's going to take a while for the business owner to be like, oh, I'm going to cut some jobs here. I'm going to buy less marketing, hold less inventory. And then that kind of gums up the supply chain and backs up things. And you don't see that play out. And that's what you're seeing here, right? Financial and housing sector went to the hard landing. Everybody else, all the kind of the followers, the other industries, I'm not going to pat Jerome Powell on the back because I'm upset at the guy. Him and I aren't friends, and I don't blame him either. His job is to engineer a soft landing. And inflation was out of control, so he pulled the only lever that he had, which is to increase the interest rate. But it's all cause and effect at the end of the day. And so let's get into some specific trends in commercial real estate. First one, observation is positive. Commercial real estate impact with increased activity expected in 2025, but continued with interest rate volatility. This impacts all sectors. So meaning multifamily, office, self-storage, that's what it means by all. But yeah, like, I think that the reaction that people need to keep in mind is diversifying across markets and timing of transactions, or when you enter your entry points, and avoid reliance on market timing alone. So that means 2 things. That means, number 1, you don't want to call the bottom and be too early, nor do you want to be too damn late. Right? Waiting till next year or the year after. And I think this is where I take this to heart and be like, look, I don't know if this is the bottom. I really don't know. But I look at things like apartments or like the businesses that we buy, and is there a long-term need for this? Are the market fundamentals right on this? And if the numbers make sense, always be dollar cost average investing is my idea. From 2010 to 2023, it was a nice bull run. Nobody could have ever known that 2023 was that peak of the market. You would have never known. If you knew, you're lying, or you should be a gazillionaire at this point. So at least where I'm at, being wrong myself, with that humble mindset in mind, I say you don't know when a correction is going to be. You just have to assume that it will happen at any point between somewhere around 5 to apparently 12 years. And with that assumption, what do you do then? Then you're just, like I said, you just dollar cost average and you invest. So one trend that I wanted to dig into is in 2020 to 2022, when interest rates were good, a lot of people, ourselves included, as developers, because we do develop, like gangbusters, because with the relatively lower interest rates at that time and the extremely good fundamentals, especially going into 2021, 2022, where rents were skyrocketing, it made a lot of the deals like really light up green and made a lot of sense. So a lot of people rode this wave and started to build projects. Think of it like in 2020, everybody was stuck at home. Sure, I guess they were fearful for their lives for the pandemic and everything. If everybody was stuck at home for a little bit, you would think that 9 months later, you would have a lot of COVID babies. I think that's what happened. I could be wrong. But essentially, that's what happened for developments. In 2020 to early 2023, there was a very conducive environment to have developments or building babies. And building babies don't take 9 months to build. They take more like 2 to 3 years to come out of the womb. So right now you're seeing that come out a huge supply and really impact the market, where you're having a huge amount of supply hit the market. And this is where you're seeing charts from CoStar say that this is on a quarterly basis, but you're seeing the amount of apartment units started. This is where the point of inception, if you want to think about it, or when you stick the shovel in the ground, and then 2 years later, in theory, is when those babies will be born. The peak there, beginning of 2022 through 2023, and you add 2 years onto that, then that's 2024 to 2025. And that's a reason why almost double the amount of units are coming online than normal. New units are Class A units, the newer stuff. So what that does, it increases the supply, and that supply will get absorbed. But what it's doing, it's displacing the Class C tenants, because what's happening is if you're a tenant, you're like, wow, that Class A apartment, maybe I can stretch my budget. And the tenants aren't the smartest people in the world. These new apartments, they give a month or two of 3 month rent. And the tenants don't really understand. It's just like a quick time discount. And they probably overextend themselves. They may be legitimately able to afford $1,000 a month, but they may stretch to $1,400 with that free couple months rent. What that is doing is displacing a lot of the Class B and C renters. And the lower end of the threshold, you're seeing a little bit lower occupancy in those sectors. Now, I think this is a trend that may continue out for another 2 to 3 years from now. But long term, this is going to dissipate when the new supply babies are all done being born. What we do know is the data's in on this, is that new starts coming online, especially getting into late 2024, are severely down from even normal. If we can stick a shovel in the ground 2025 and it being built in 2027, you're having a good amount of all this supply getting absorbed, and there's going to be a dry spell happening. And this is all stuff that we know now, right? The data on this is very readily available through CoStar, Yardi, RealPage, great resources. So yeah, rent growth is expected to rebound in 2024 with a 1% increase across major markets, which is a little bit is lower than normal. Normal, you want to keep up with pace of inflation 2 to 3%. So rents are growing, but I would say because of the new supply, you're seeing that sluggish. But like I said before, we should see us turn the corner, I would say sometime next year. New apartment construction is down 25% from last year, which should lead to higher occupancy rates and rent growth in the near term future. And again, my hunch on near term, maybe the end of 2025 into 2026. And this is just another couple of resources here. This is from CoStar, October 2024. Basically, the story is the light at the end of the tunnel, the delivery falling off in 2025. And then as these apartments come online, the 2023, 2024 peaks of new building babies being born, you're seeing them get absorbed, right? This is the game of supply and demand. New supply, a heck of a lot more supply than normal, getting put into the dating pool, if you want to call it that way. Since we're talking babies here, it gets thrown in there. But which of them are finding mates, or in this case, finding a tenant? And that's what is called absorption in the industry. So you're seeing these units are getting absorbed, right? Which speaks to partially some of these numbers that we don't know, which is the demand. If absorption falls down, then we know the demand is not there. But absorption is showing that it is strong. Again, to recap, focus on newer, more institutional assets. Again, this is a weakness for the next 1 to a couple years. That weakness is going to be more on the lower end Class C and B properties. And it's something that I think we've maybe outgrew ourselves. Like I think with Class B and C assets, that's where we got our start. We had some good exits on those, but it is difficult because the tenants are real difficult. One of them, we made great money, but the thing never got more than 80% of people on collections, meaning that 1 out of 5 people were just deadbeats and never paid us, yet we still did well. But also when you're dealing with like crappy 1960s, 1980 property, no matter how much due diligence or third-party inspectors you get, things are just going to break. It's like getting manager mechanic for why your 1996 Honda Civic XYZ broke. It's just going to happen. That's just how it happens. Still focusing on the Sun Belt due to the long-term job growth and population growth. Those are the market fundamentals. Although I think the next couple years, you're going to see this new supply hit the market, then back off. That's all short-term stuff, right? And I think that's what we want to keep aligned more in the long term, the vision on the horizon, the long term. And then when you combo that with long-term debt, 5, 10-year or 8-year terms, assuming the numbers work, it provides a strategy where you can stay in the game, do value add, and more than likely, assuming that the market comes back, you look like a genius. But if not, I will be happy to invest in a flat market. I do think that inflation is going to come back. So if that's the case, buy assets, buy things that go up with the pace of inflation. I think with that, I don't give any financial advice. That's all your guys' job. And you guys, but if you're sitting in a money market account because you think you're clever for getting these higher rates, it's coming down, but that's the stuff that is going to get killed by inflation. 2024, to substantiate some of these numbers, was a supply high of 650,000 new units, a 40-year record. And again, that's all at the tail end of those interest rates, 2022. And remember, the interest rates started to go up, and boy, did they go up really quickly in the summer of 2022. I remember because I was drinking wine in Napa in the end of that year, and we had just refinanced one of our developments to a long-term permanent financing, and the interest rates were just moving so quickly. And I just thought to myself, whoa, we really got lucky because it was getting really bad once you got into 2023 in terms of interest rates. And that was at a point where developments, if you were smart, you put it on hold, you put it on ice. But also from a demand standpoint, 2024 net absorption surpassed that of 2023. And we talked about some of the dynamics between A, B, and C properties. That's temporary. I think that's a trend that's going to happen. I'm not saying that I never want to buy Class B and C assets, but right now I think the A's make a little bit more sense, 20-year or less. Again, to remind people of the long-term trends, the fundamentals, the things that are 10 years more longer term. As of earlier this year, renting is $825 cheaper per month on average than buying a home. We are becoming a nation of renters. That's why the dynamics and population is going up in America, especially in the lower middle class and these specific submarkets. Another couple miscellaneous trends to watch: natural disaster impacts. I was just talking to some investors about skyrocketing insurance costs. something that we've seen even as early as 2020. I think everything that we see happen comes out to you guys like 3, 4 years later. Individual homeowners insurance, condos insurance. This is old news to us. I remember our apartment in Mississippi, like our insurance tripled on that one. This is maybe, yeah, around the pandemic or even before the pandemic. As I understand it, or what the insurance companies tell me or brokers is right now where insurance costs go up and down, it's cyclical. Of course, just like inflation, it never goes back down, right? Things always get more expensive. But there's somewhat of a curve, a flow that's ever pacing upwards. And right now we're at this peaking moment. Part of that is caused by a lot of these reserves are being drained by just a lot of unlucky supernatural disaster events. Hurricane Helen, good example of that. And then especially hitting certain sectors, like we don't want to invest south of Birmingham, Alabama, for example. Work done in the lower Harris County, Houston, for example. That is more because of the taxes too. But if you get on the southern part of Houston, and if you're not a local and you don't know where the 100-year floodplains are and the real floodplains are, your insurance are going to skyrocket. Florida is a lot higher insurance out there too. But the closer you are to that Gulf, southern part, the worse it's going to be. Jacksonville is on the other side, a little bit less of a insurance increase factor there. But I think that's something to take note of. What you're seeing a lot of operators do is they'll buy these more portfolio insurance policies. It covers all their assets and then they just appropriately divvy out the costs. There's some issues and risks to that. I think the way that where our heads are at, it makes more sense just having more coverage and being able to sleep at night that a policy per asset. But those are just some of the things that people are doing out there to cut some corners and make things work, right? Because taxes and insurance have skyrocketed, and that's not in the control of anybody. You can't not have insurance. The mortgage companies, the banks, they require insurance. Office vacancies remain high with net absorption and many other properties viewed as distressed. The issue is like long term. And I come back to, okay, what's going to happen 10 years from now? People still going to be using apartments, need a place to live. Depending on what area, I'm pretty bullish, right? I think that's everybody needs to come up with their investment thesis. We had some big changes with how people work from home through the pandemic. And maybe call me a little old school, but what I talk a lot in my business boardrooms, where a lot of us business owners talk and CEOs talk, is it really is difficult for people from a social and collaboration point of view to get things done and come up with creative ideas when everybody's working from home and there's so many distractions. And yeah, I get it. It's good quality of life. Nobody wants to be stuck in traffic, but I think this is why you're seeing creative companies like Apple telling everybody needs to get their butts back into the office so they can actually mastermind things together. Maybe that's just a sign I'm getting old. But either way, I think it's up in the air whether office is going to be as needed as it once was. But what we do know now that you're seeing a lot of distress in that sector. And you're seeing some banks right now, they're heavily underneath where the asset is worth. And even the banks are wondering what the heck do they do with this? You can repurpose an asset that takes a lot of money to do. But when people talk about commercial real estate, mind you, they're talking about office, self-storage, apartments, even manufactured housing, all kinds of real estate in there is what's considered commercial. All right, so let's talk about the election. So here's what Trump said. Trump has often criticized the Fed's independence, suggesting it limits its economic growth. So he is obviously going to put pressure on the Fed. Who knows what's real these days, right? Supposedly, some people say that he has like a personal vendetta against Powell, and Trump owns a lot of real estate. So it behooves him to push the interest rates down. But even from an economy, right? You push interest rates down, the wheels start moving in the economy. I'm not going to pontificate if that's good in the long term. What we're trying to do here is just dictate on what is going to happen in the near term. This is, I think, where we do get a little bit more near term, meaning what's going on the next 2 to 4 years. We're recording this the end of 2024. We know Trump's going to be in there, but we don't know what the heck he's going to do in terms of economic policy. We know what he said, and that's what we're talking about here, but he was just trying to win the election, right? Like, and that's where we're going to be doing a webinar. Have the CPAs coming on in January. We're trying to hammer down a date to bring them on and analyze some of the early indications on what actually the policies are going to be. So if you're not on the newsletter, I would say get on it. It usually comes out every Tuesday. You can get that at thewealthelevator.com/club. But I think if you're thinking Trump's going to get his way, he's going to lower these interest rates a little quicker than what was originally expected. A little bit less emphasis on inflation control because he generally prioritized growth and employment over inflation concerns. Why this might be a good thing for investors. So economic coordination just could increase the efficiency for aligning fiscal and monetary policies. I think he generally has this idea where he wants to remove barriers, less government regulation. When you remove those barriers, you would think that money and business flow a little bit more streamlined. Now, potential risks, I'm not going to say it's all good. I think it's generally better for investors, but I'm going to watch my tongue here to don't want to offend anybody, or everybody's got so many opinions these days. Just relax, guys, and just trying to call it how it is. I don't know if it's good in the long term, but I take the stance where, all right, as an investor, actually, I will take the stance. I am a libertarian by nature. I just want to know where the puck is going, and I'm going to skate to the puck. I'm not going to say whether one is right or what should be done. I'm going to shut up and do what's best for myself and my family. I don't care what you do with your body. I respect everybody. I want to be inclusive to people, but maybe it sounds selfish, but hey guys, it's just money, right? At this point, I think that's what the definition of a libertarian is. But so I try, hopefully you guys, when you guys listen to some of my talks, if I come across as one side or the other, I'm really not. I'm just trying to read the situation and trying to position myself the best way. Trump's talks of putting in more tariffs, and this is something I don't completely understand myself. Like, how does that impact economically in America? You would think that is going to increase demand for US labor and production because now we're maybe buying things less outside of the country. I don't know the other repercussions of that. I know he's also big on oil and gas and crypto. So I know a lot of people in our community, they love those oil and gas deals for the tax benefits. I would always be careful, guys. Like, I haven't really found a good operator. I'm an investor in this oil and gas deal, and I guess they want to put me in another fund. I don't know what the heck is going on, but I've been barely getting since I started. I got the IDCs, the tax credits essentially, but I think that's the hard thing with these oil and gas deals. You're literally drilling a hole in the ground, and yeah, you get some tax benefits from it, but at the end of the day, maybe call me old school, but I just want to invest in a piece of real estate or a business that's performing, and maybe I get a little lucky with some market appreciation. But yeah, as far as I mentioned earlier, less government regulation should bode well for the crypto fans out there. Deregulation on that. Again, I don't know the repercussions of that type of stuff long term. As we've seen, there's some failures here on Turkey, Argentina, Venezuela, Zimbabwe suffered severe economic instability with inflation. But, obviously better than those countries, especially because we have the best military, we control monetary policy. And then other successes of this type of economic path in the future, like the US World War II. It seems like the wars helped things out. Israel in 1985, the UK in the 1930s, and this achieved stability with targeted temporary interventions. What we do know is commercial real estate is down, and there are signs that have come back up, maybe as far as 6 months ago and coming back. Interest rates are coming down. But I think there's a tale of two tales here, right? You have deals that were purchased at the peak. You can't do anything to change that. And why did the prices come down? In commercial real estate, you have the market price, and that's dictated by the net operating income. Or those of you guys who are familiar with EBITDA, Basically, your income minus your expenses. Think of it like that, divided by your prevailing cap rate in the market. And this is why the exit cap rate in that syndication e-course is so important. And you're going to see this play out. So here on the right side, maybe you buy a property for $100 million that had a $4 million net operating income. And the market, prevailing cap rate in the market, meaning you ask the broker, hey, this Class C property in this soft part of Fort Worth, what's the cap rate? And they'll say a number like 6, right? In this case, it was 4. So that's the magic formula to get the market price. But what happened is you saw the cap rates, because the interest rates, as we mentioned earlier, totally go haywire, and it increased. And again, this is what confuses a lot of people when they're new to this. When the prevailing cap rate increases, you're seeing the market price drastically decrease. So same asset. Heck, you could even have an asset that's making even more money. But because that the impact of that denominator is so strong, the market value plummeted. And this is essentially what happened the last couple of years. Now, what if somebody was like, all right, we're going to increase the business plan. We're going to do it all in one day, renovate all the units and increase the NOI from 4 million to 4.8 million. But if you're still selling it in that same crappy 6 cap rate market, your property's still way less than what you bought it for. And this is the situation that you're seeing pretty much all assets out there. Maybe your loan is good, but your market value is pretty much what it was in 2020. It's like you went on a nap and came back. But what this means is properties with the established basis, or what the heck they bought that thing for, you can't shake that. You bought it for 100 million and now it's worth 80. And you may be forced to sell now, or you may be able to hold it. But you're going to have to wait for that thing to come back to 100 million, which may take several years for that to happen. For those properties purchased between 2020 to 2023, you're screwed. That's the basis. You can't change that. Now, this is where it's very unfair for new investors entering new deals today with the prices of today, the after, buying this thing at 67 million, same NOI at the higher prevailing cap rate today, which is not controlled by anybody. It's controlled by interest rates and 30% other things, as we said earlier. You're buying it at this price, and that's your basis. That's your entry point. So if the cap rates return to what it was at 0.04, you just made 30 something million dollars right here for not doing anything. Now, this is a huge jump, right? And what we've seen happen transpired is a huge correction, bigger than 2008 in commercial real estate. Now, I don't think it's reasonable to expect a 2% cap rate change to reverse back to where it was. I think it may take at least several years to get there at the very least, but maybe it comes down to a fraction of that. Still, the trade winds are at your back, but more importantly, I'm getting back to this and I want to hammer home or push this point home. The basis today that you bought the asset is low. Not saying that it could go lower, but it's low. So we can't tell the future, but CBRE, this is their projections on what's going to happen in the future. So you're seeing the 10-year Treasury there, the bars, and I got the Chatham Financial curve coming up for those of you guys who like to place bets with your friends where interest rates are going to be. CBRE's predicting that interest rates in the 3s in a couple of years, and then maybe settle somewhere in the 3 long term. But I think guarantee something is going to happen that's going to change this. A war, pandemic. We know there's uncertainty in life. You're seeing the cap rates. And if you're just focusing on multifamily one here, and of course, this is industry wide, the data is going to be bringing in all markets, all asset classes, but just relatively speaking, they're pointing to right now is the peak of the prevailing cap rates, which since we know from the last slide, that's bad, right? That means your property is worth less. But we're seeing that come down. They're saying like, if I read it from this notch to this notch, that's a 0.5 point correction or compression in 3 years, maybe a little bit more than a full point in 6 years. I'm hoping it's going to be a little bit more aggressive cap rate compression, but I think this is a good guess because nobody knows. Nobody knows. Here's the Chatham Financial curve, and this other one, this is the more current one, but I just wanted to show where we were looking in mid 2024. These predictions change, but at this point, they were calling the near term low January 2026. And I don't think that they called for a half a point drop right away, but you're seeing this is the more mature, the latest and greatest. This changes by the minute, but you're seeing us at 3.68 come this time in 2025. So what this means, if you're seeing like a full point coming down, so maybe a quarter point every few months is the trend line. And of course, this doesn't really impact like the 10-year Treasury 1-for-1 or what mortgage rates are, but this is where the beginning of where the Fed dictates the rates and everything's extrapolated from there. But that is the end of our 2024 walkthrough. A lot of good things. If you're reading between the lines here, we don't know what's going to happen in the future. One could assume that interest rates are on the decline as they have been, barring a black swan event, which you never know can happen. I can't really think of too many. When you take a SWOT analysis, strengths, weaknesses, opportunity, trends, I see a lot of more strengths. And if you guys are interested in seeing more of a detailed report, you guys can email our team and we can get you access to some of those if you'd like to geek out on that. 2025, 2026 from an economic perspective is lighting up green. It says ITR economics. Of course, still you want to buy best-of-class assets and best-of-class businesses in the private equity side that we're doing now. But I think that the trade winds do appear to be on our back, but it comes at a time where, and it's an emotional thing too, for those people who were in the market in 2021 or just entered the market in 2020, that was probably the worst time to start. It's tough emotionally to re-enter the market when you've had struggles, which makes a lot of sense, right? Like when deals are the best, when liquidity is at its less. Oh my goodness, I didn't intend to say that Dr. Seuss rhyme thing, but that makes a lot of sense. And also in 2021, when rents were skyrocketing, inflation was high, asset values were going through the huge gains. It was also a time where investors on the investor level were just going into deals and it was rolling. And yeah, it said we were going to do it for 5 years. It took 2.5. And we just wrote, people had money in their wallets and just rolling. And right now we are at the complete 180 of that. So it's one of those things. You either have like deals or dollars, one or the other. You're very rarely in equilibrium. Just like you have busy at work and quality of life, you're never going to be really balanced. You're always going to be imbalanced at some point. But I think it takes a couple of market cycles for people to realize that when things are fearful and scared, that's the time to enter the market. And that's what the big players, KKR, has done. I recognize these things myself, but I think the way I take a look at it is I'm not going to call a bottom. I'm just going to just dollar cost average is my approach on this and re-diversify the portfolio. It is the way I look at it. But I think the big thing is if you guys haven't yet interacted with our group in person, I would highly suggest coming to the January retreat and meeting other investors. The big missing part of this, as I talk about in my book, The Wealth Elevator, there's different paradigms to this wealth building journey. So it's hard to tell where the heck people are unless you get to know each other in person, you break some bread with them, have some beers, and then you can get a little bit better idea on where they're at. What's your net worth is what I'm getting to. And then at that point, what is your asset allocation mix? I've never been one to say you need to have this much. I think in our world, there is no normal, and people in our world need to understand that. But the hard part is like seeing what some of your peers are doing, not the peers who have 90% traditional investments and 10% life insurance, right? What are the people who have more than 30, 40% alternative investments are doing? What is their asset allocation mix looking like? I haven't really figured out what the heck that is. I think it changes over time as you start to accumulate wealth.